So do you have some equity in your home and you'd love to figure out a way to access some of that money, but you're not sure what products are out there or what things could help you get some of that money out of your house that you've spent so many years trying to, pay off, and now you would like some of that money back to use in retirement? Well, you were in luck today because I have Lee Smith here from Fairway Independent Mortgage Company, and he is going to kind of talk about some of those different options. There's actually three options you have available to you, and one of those that maybe you don't know too much about. So, Lee, I'd like to introduce you to the group. You work here in Lee Summit. Tell us a little bit about those options that you have available or that homeowners have available to them if they're trying to pull some of that money out of their home.
Yeah, Julie. So, I mean, essentially you have three options, especially when you're at retirement age, to access the equity within your house. You could use what's called a cash out refinance, which is pretty basic. You just, depending on the equity you have, you can pull X amount of dollars out based upon the value of the home. And then, of course, you do have a monthly payment associated with that, but that is a way that you can access the money with that. You also have the very popular home equity line of credit that pretty much most your banks are going to offer. Once again, very similar to the cash out in the sense to where you're going to get a percentage of what the house is worth to what we call loan to value. A little bit different typically on the home equity lines as they're the way that they're structured, and they have to have a renewal period and everything else. And then the third option, which is probably not the least talked about, and the kind of the area I specialize in a little bit, is using a reverse mortgage, or what FHA calls them, a HECM, a home equity conversion mortgage, to access that money in a safe, secure way.
Okay, that sounds good. So yeah, I think most people are pretty familiar with those first two. The problem is that it creates a payment then that that the homeowner has to maintain, which for a lot of people doesn't work anymore because they're on a fixed income, or it kind of defeats the purpose of needing to pull money out. Maybe they're needing it to, maybe some people are wanting to stay in their home and they need to make some changes to it or pay for care or different things. There's several different ways that works. So sometimes people hear like, oh, reverse mortgage, and they have they have some bad connotations, or that brings up some things that, people say, oh, you don't want those, but it's really not as bad as people say, is it?
No, I mean, it's always kind of comical as I've done this for long enough now, and I've talked to enough clients and realtors and financial planners and everything else, is what people think the reverse mortgage product is to what it really is. Yeah. And frankly, it is a safe, secure way that's guaranteed and insured by the federal government, the way to access the equity in your home. And there's only four things that are required when you have a reverse mortgage: is you have to pay the property taxes, the homeowner's insurance, HOA dues or maintenance dues, whichever you have, and then live in the home as your primary residence. If you do those four things, you're able to stay in the property until you can no longer permanently occupy it, or until you turn 150 years old, whichever happens first. So that's how I tell people, that's how you know it's a government loan, right? That's how you know it's a government-backed product. But the most important thing is, and what you alluded to earlier was correct. When you do a cash out refinance or a home equity line, which are both very, are options to always consider, but those do have payments. And what we traditionally see as somebody goes through retirement, their income does not increase. It will either stay the same or actually decrease a little bit, depending on what inflation is and how much their money is growing and how much they're able to spend. And it's been said before, the most dangerous thing you could do to somebody on a fixed income is give them a fixed payment, because it just erodes away that income that can be used other ways. So when we look at the reverse mortgage product, especially at our people that are at retirement age or even nearing retirement, is what's a safe, responsible, and guaranteed way that they can use this product and add to their overall retirement picture instead of take away, which is what a lot of people for some reason think.
Right. So what are some of the other, what's the process to kind of get this started? I know I've spoke to you before, and you do a really good job of evaluating people's situations. It's not like, okay, you need a reverse mortgage, this HECM product's for you. You really analyze things and take a look at all the different scenarios first.
Well, and that's the one unique thing about where I work at Fairway, is that we do both traditional and reverse mortgages, and I do traditional mortgages on everyday basis. So it does allow me to take a step back and take a look and say, okay, what is really best for the client? But the biggest thing we always want to know is, what does retirement look like? What does that income look like? What expenses, do you know that are coming up, or what do you know that's happening? There's all sorts of variables. What's very unique about the reverse mortgage product is that it's one product in itself. It doesn't matter if you have $1 million home, we can do this, or you have a $50,000 home. Everybody's going to have a different use for that product. And so what's important with that is making sure that the product is going to align with what your goals are and what you're wanting to do. Because that's normally the one thing. If somebody calls me and says, hey, I want a reverse mortgage, my first question back to them is, well, why do you want one?
Right.
Tell me why you want this, because I want to make sure what they're getting, what they're wanting, right? With anything, you don't go buy a product without knowing how it works or what it is or anything else. This is not an impulse buy item. This is something that is going to be with them for a while, and that can be hugely beneficial to anybody's retirement picture. But we always want to make sure it fits for what they're wanting and what their expectations are.
Right. And you can run the numbers and give them different scenarios, right? Like, this is what it looks like with a traditional, mortgage or a line of credit, or this is what it looks like with a reverse mortgage.
Yeah, it's always a great conversation we have that we try to dig in deep, because we'll look at all three. I mean, I don't do home equity lines of credit, but I can I've worked at a bank in the past, years ago. And so I understand how they work and the pros and cons, of each option that you have. And, the one, where we always come to, especially when you're in your mid 60s, mid 70s, or even into your 80s or whatever age, because only one person on the loan has to be 62 or older. So when we really start to take a look at this is, what is the long term? And normally when you take a look at the reverse is that it doesn't require a monthly principal and interest payment. You still have the other four things we talked about earlier, but it doesn't require that principal and interest, which can be huge, because as I always say, if you're pulling money from the house in the line of credit or within the reverse mortgage, or if you use it to stop a mortgage payment, refinance and eliminate your mortgage payment, what are you doing with the money that you're no longer putting into the house? Or if you're pulling, let's say $5,000 from the house to go replace your HVAC system or whatnot, where else would that money have come from? And a lot of times the what we want to look at is, okay, we can pull this from, let's say, my investments, my IRA or whatnot, which that may be a good idea. But what if, you have a negative return year in the market? Or what if, that you've already pulled enough and you pull any more money out, it's going to bump you to another tax bracket? There's all these what ifs. And really the best way, in my opinion, to make it through retirement is have access to as many different buckets of money that you can, whether it be your Social Security, any pension income, IRA, other investments, but use the home equity as part of that picture, not as a sole option. I mean, it can be, I guess, the sole option, but the majority of clients we work with here, this is adding to that picture. So if they have a $20,000 expense, let's say, for whatever reason, they're not pulling all $20,000 from an investment account. They may be only pulling 10, or maybe they pull all of it from the reverse and none from the investments, or some sort of a mixture in between that allows the money to stay invested with their advisor for as long as possible.
That's a good point. So I know there's a lot of steps that kind of go into this, but can you kind of give us a little breakdown of how that would look to do one of these, or is that, can you?
Yeah, I mean, the most important, yeah, I mean, starting with the conversation and just, when I talk to somebody initially, I just kind of get to know them. I want to understand what's going on, tell me about the current house, tell me about what retirement looks like, tell me, kind of what are some, do you have any things expected coming down the road? What are your concerns? What keeps you up at night, right? That's a very important question, because, people that are, have funds, have retirement funds in a market-based system, especially, when we hit election years, are very concerned about where things are going to go. Now, of course, I never use fear to sell anything. I just want to, I want to make sure I understand where they're coming from. I had one gentleman we did the reverse for, but he came to me and he said, hey, I want to do the reverse because they're going to stop my Social Security. And I was kind of like, well, wait a minute here. What do you mean? They're like, oh yeah, the government's is gonna stop Social Security. I said, look, if you do the reverse or not, that's fine. I said, but don't do the reverse because you think your Social Security is going to be stopped. Right. I said, there's not a politician that has a backbone or has any notion to take away Social Security, because then they're not going to get reelected again. And the most important thing politicians do is want to get reelected. And so it's always important that I make sure, that we are going through with that client to understand that, is this a fit? is this going to be something that can fit them or accomplish what they're wanting to accomplish or offer that extra net of security? And as soon as we get through that phase, then we'll sit down and actually look at numbers. I very rarely even look at numbers on the first appointment or first meeting, just because, as you know, in this space, there's so many misconceptions. And the biggest one we typically deal with is, the bank's going to take my house.
Yes.
And I kind of find that very comical.
Yeah. And that was one of the questions I had, is that, that's what I've heard before. Like, well, they're going to take my house, or, so how do you, they say it's a non-recourse, is that right? Non-recourse loan. And so what does that mean exactly?
So, I mean, on the non-recourse feature, that's all the great benefits of it being an FHA backed and insured product. So, the way a reverse mortgage is done is really no simple as far as how liens are filed as a regular mortgage. You are always still an owner. The homeowner is always in ownership. At no point do they lose ownership or it gets transferred to the bank, is what I always like to, is what I always hear and kind of chuckle at a little bit, is essentially, the non-recourse feature of that makes this a pretty unique product in the sense to where that if for whatever reason it goes upside down, so more is owed on the house than what it's worth, then FHA basically picks up the tab, on that. And so on a traditional mortgage or even a home equity line of credit, if that were to happen, then they're going to come after the estate or you or whoever to get their money out of it, right? Because you signed that you're personally guaranteeing that money. What's different on the reverse, and why we'll make this a non-recourse, why the non-recourse feature even exists, is because the loan is actually on the house, not the person. So this does not show up on somebody's credit report. I can pull a credit report where somebody has a reverse mortgage. It's not going to show a mortgage because all the bets are on the house, because theoretically the house will outlive the person.
It will appreciate with the...
And it should appreciate, right? I mean, is there cases where I've seen the house go upside down? Yeah. But very rarely, it's not because of the reverse mortgage. Generally, I would say 99% of the time that I've seen, and I'll leave 1% because there may have been something that I'm not recalling, but almost every case I hear when a house is upside down, it's typically due to lack of maintenance or just a dilapidated property. And most of the time, and you probably know this story, Julie, one spouse passes away, the other spouse is unable to take care of the property or don't have the funds to take care of the property anymore. And then just doesn't, is not able to have anybody to help them. And then it just slowly goes down over the years. And that's typically the cases that I've seen where these things have gone upside down. But the great thing is that FHA is not coming back in and saying, hey, well, we want that $25,000 in the bank account because they went upside down on this loan or whatnot. FHA just writes it off and moves on. And so that's what makes this a safe option for anybody using it in retirement, is because of that non-recourse feature. Will basically give them a guarantee that FHA will never chase them for the difference for whatever reason, whether it's housing market, and really whether it's your fault or not. Now, granted, they want you to maintain the home. It's a good idea. But even if it's your fault for not maintaining the house and it's lost value, FHA still offers that non-recourse feature as part of it.
Okay, that's great. That's great. So what are some of the requirements to obtain this, to, get the reverse mortgage? What are you looking at, credit scores or anything like that?
Actually, no. I mean, we, very rarely do we care about credit score. We typically look at credit history. And that's where we run into some issues sometimes, is if people have late payments on the credit report on installment debts, car loan, if they have student loans or whatnot. And then especially on their mortgage, if they currently have a mortgage, they have late payments, that can be a red flag. Also taxes and insurance. So if the property's paid off, we're going to go look at their 24-month property tax and homeowners insurance history, how they've been paying that. Now, if they've been paying that late, does not disqualify them. It just changes the structure a little bit of how we do it. We have something called a life expectancy set aside account, or a LISA, that we're forced to set up for them in many cases, but that's always a case by case. And we do have the options to get those waived if we can show it's a one-time event. There's with anything, there's plenty of paperwork involved, but the unique thing about the reverse is we really don't care about the credit score. It's irrelevant. I've got plenty of people that I've got one right now that's got in the 500s, and it's because she hasn't had any lines of credit open in 4 years. And she had some old collections and charge-offs, but it doesn't matter. We're all good. We're moving forward and we're getting taken care of. But the credit score means absolutely nothing to us. It's all about the payment history. But it's very hard to get disqualified from a reverse mortgage, is most of the time they don't have enough equity possibly to make it work.
Okay. And so that's the key really is how much equity you have. You don't have to have the whole house paid off in order to do this reverse. You just have to have a certain amount of equity built up in the home, correct?
Correct. It's based upon your age, the current interest rates, and what your house is worth. And it's, when I say the age part of it, it's the youngest person. So if you have a 65-year-old and a 55-year-old, we're going to go off the 55-year-old's age as far as for how much equity you can have access to, because FHA makes it very clear. If you're married, you're both protected. And so even though that person's under the age of 62, still they get the same protections in the event that the older spouse, passes away, because they make the assumption that if you're older, you're going to die first. Now, whether it's true or not, nobody knows. They're not going to do any medical checks. There's nothing like that. They just assume, even if you're 2 years older, you're going to die first. Okay. So they're always use the younger person's age as part of it. And so but that they're very adamant. If you're married, you're going to be on it together. I mean, there's no ifs, ands, or buts about it. I mean, there's very few exceptions to that rule, and that gets a little more into the weeds, but but it is a very safe product in the sense to where not one person can do it and leave somebody else off, because even after the primary, spouse passes away, as long as the other spouse still pays the taxes and insurance and HOA dues and lives in the house, they are just as protected as well. So
the younger the person, let's just say somebody that's 75, or let's say 80 years old and 70 years old. If you're 70, you're going to the payment, or you have to have more equity in the home. Is that right? Do I understand correctly?
Yep, that is correct.
Okay. The percentage of equity is higher the younger you are. Inverse thing. Okay. There's no, I like that you said there's no medical check as far as, you're really sick or you're really healthy and you're going to live. They're not looking at any of that. It's really kind of just the home that they're looking at and what the home is worth at the time of the loan. Is that right? So they do a full, gosh, I want to say inspection, but that's
appraisal.
Yeah.
Yes, a full-fledged, appraisal is done on the property at that time because after they do this loan, they may never look at that house again for, 10, 20, 30 years, depending on however long you live in that house. And so, do you have to go through a little bit more on a reverse mortgage than you do a traditional mortgage? Yeah, absolutely. But there's no traditional mortgage I know out there that offers a non-recourse feature that gives certain guarantees, because, on my house, I'm personally guaranteeing that I'm going to pay that loan off no matter what. Right. It's up to me to do that. And this is why it's a little bit different. So, that's probably some of the most challenging side of my end of everything, is just the extra hoops we have to jump through every now and then to get a client taken care of. And a lot of times clients do get frustrated because most of them have not had a loan in, 10, 15, 20 years, or haven't gone through the loan process and even longer. And they don't understand, after 08 happened, oh my goodness, just the regulations that were put in effect and everything else. And so we've had so much change in our industry over these years, and I've baby stepped along with most of it, but they haven't. And so just kind of making sure we're holding their hand through it, telling them everything's okay, we're going to get through this. We're sorry we have to ask for this, but it all has its reason and its side. And I always tell people, hey, let's begin with the end in mind. Here's where we're going. And so yes, we're going to need some things up front, but the finish line is where we're trying to get to. Yeah.
Well, even with the traditional mortgage, I mean, there's so many more requirements and things that people need to turn in. It's amazing. So it maybe is a little bit more for this product, but it's, it's still quite a bit for any mortgage. And if you haven't done it in 30 years, you'll be surprised like how many things are out there.
That's exactly correct.
Yeah. What about the costs? Are there additional fees or costs, or what's involved in some of that?
So as I tell everyone, this is, if you're looking back at the three options, especially if you own a house already, or if you're looking to buy a house, because you can use this as a purchase option too. But, this is the more expensive option between a cash out refinance and a home equity line of credit, but it also offers it's a completely different product in what those are. And so I've always thought in life, and said, you always get what you pay for, right? I mean, if you buy something that's really cheap, then you're going to get really cheap, from it, or you're not going to get a lot of use from it as far as that goes. So, as far as cost goes, it just really depends. Typically the biggest cost driver with it is the property. So if somebody has, the loan limit right now on this product is $1,089,200 or $300. So basically just under 1.1 million. And so if a person's doing this, let's say $1 million house, they are going to pay more closing costs and more fees than the client I'm working with right now that has a $200,000 house. So it all is based upon what the property is worth. And generally, as a good rule of thumb, I say it's going to cost anywhere from 3 to 4% of what the house appraises for. Now, of course, that's very general, very broad. It kind of gives you at least a ballpark of what it is. But just with anything, and that's the one thing we always want to make sure is the cost benefit analysis that we have with this. At what point does it make sense? How is this product, how is this best being used, and so on and so forth. And so that's one thing that is very important in that conversation, is to make sure that we're kind of talking through it. Now, the one thing we've seen as interest rates have been kind of fluctuating over these last 18 months or so, what's unique about the reverse product is the fees have not changed at all on the product, really, since I started working with it over 5 years ago. The fees are pretty much exactly the same. The biggest change we've seen, obviously, is when interest rates go up, it just requires the homeowner to have more equity today than what they would have had even a couple months ago, a year ago, or 2 years ago. And so that's really the biggest change, is not that it costs anybody anymore. It's just they have to have more equity, which really, when you take a look at it, that's not such a bad thing, especially for a lot of clients. But it's often funny, when a client understands how this product works and we go over the numbers, they're always like, oh, I thought I was going to get more. It's like, well, I mean, if you would have done this 2 years ago, you would have, type of deal. But it's okay. People, they didn't know, or they didn't quite maybe understand what the product is. But that's a very important thing that I point out to people, is that they haven't changed the fees on this product at all. It has actually stayed very consistent over the years. It's just that, today you have to have more equity.
Okay, that's a good point. You also, just a bit ago, mentioned another point, which I wish I would have brought it up at the beginning, but is that you can do this on a home that you're purchasing. It doesn't have to be one that you're already in, that you're going to live in for the next several years. You can do it on a new purchase. I think that's a pretty important point as well.
Well, and that comes into, when you buy a house, you have 3 options. You can pay cash, you could do a conventional mortgage, or you can do a reverse mortgage for purchase. And once again, it just comes in what fits you. I never tell people there's never a bad option, right? It's not like, oh, this one's bad and this one's good. I mean, each option has their uses. And the one we just closed, we just closed one on Monday, but one of the recent ones we have here locally is, we have a gal that had about $360,000 in cash, essentially, that she could buy a house with. And she was just looking to buy something over in Raytown. And, she looked at, she found the perfect house. It was actually a beautiful brick home right next to a park in Raytown. And I think she ended up purchasing for about $315,000. Well, she could have paid cash for that property. And that was definitely an option. And when we sat down, we took a look at actually all 3 options: paying cash, doing a regular mortgage, and doing the reverse. Well, basically, she was in her 60s. And when we looked at the reverse product, I think she had to put down, when it was all said and done, about $210,000. And so it comes down to, where is the money best being held? And in this case, as we worked through it, that $100,000 or $105,000 that she could have put down on the house is better with her advisor, sitting in funds that she has liquidity to it later, than putting it all into the house. Because, I mean, it's definitely an option.
Yeah, you need, if you ever need access to that money, it's much easier to access it, like you said, with your financial advisor or those products, than to try to figure out a way to get that back out of your home. Again.
I think one of the key for a sustainable retirement is trying to leave money under a financial advisor's investment or purview for as long as possible. Because the longer you have the money with them, the more chances you have to grow in the market and have a return that you have liquidity to. Real estate is not, I always go back and forth. I don't really consider most real estate an investment, especially when it comes to a primary residence, because equity is worthless in retirement. It looks really pretty on paper. Right. I can write down the amount of equity I have in my house. It looks great. But the only way I'm going to access that equity is borrow against it and have a payment, or sell the house, but then I've got to move somewhere. And so with that being said, trying to keep funds as liquid for as long as possible, or at least where you have the resource and access to it, is always, very vital when you're going through retirement, because otherwise you could tie up $315,000 or whatever she could have in this house, and could have done it and been okay, right? She'd still make it through, but then her cash position is that much less. And so what we always have to take a look at is the what ifs. I mean, things may be great now, but they're not always going to be great. Things are going to happen. And, just if you look at the odds of it, I think 70% of people at retirement are going to need some sort of long-term care. Now, what that long-term care looks like, is that a $10,000 expense or is that a $300,000 expense? You don't really know what that's going to be. The best thing you can do is keep that money liquid. And like I said, I would typically say with some sort of a financial advisor, keeping that money there, because then at least you have an ability to earn a return on it.
Yeah, no, that's a very good point. And one that a lot of people don't think about. You think, oh, I mean, like the goal is to pay off the mortgage. So many people, that's especially some baby boomers and some ones that are older. That was just like drilled in our heads. Like they want to pay that off. So,
well, it's the mortgage burning parties, right? You have a lot of people that attended mortgage burning parties back in the 70s and 80s, but that was a different time, right? That came from a lot of people that grew up or around the Great Depression. And that's when banks would take homes. And granted, it's so, when people tell me that a paid off house is best, I'd be like, well, are you still doing business today the same way you're doing it even 20 years ago? And very few people are saying yes to that. Everything changes with the times, and how things are used have changed over the years. And people don't like debt, right? And that's really where that was mortgage, where people said pay off the house because debt is bad. Well, I mean, you can always have that discussion and that debate a little bit, but what's most important about the reverse product, and the number one thing I always want people to take away, is that this is a product that does not add any additional risk to somebody's retirement. Because even if they don't do the reverse, let's say, and they have a paid off house, or they continue making their mortgage payment, they still have to pay their property taxes. Right. They should be still paying their homeowner's insurance. I mean, I guess it's not required if the house is paid off, but we could all agree it's a really good idea to have homeowner's insurance. Yes. Yeah. They're still going to pay their HOA dues, because if they live in an area with an HOA, it's going to be a requirement. So those three things are already going to happen anyways. Yeah. So the reverse is not the additional thing the reverse requires is that the property that the reverse mortgage is on is the primary residence. Yeah. And that's it. And
and it's not adding a payment. It's not adding any additional payments, because you're already paying those three things and you live there already. So it's
not adding any risk.
It just
if you do those four things, you're there. There's nobody that can take that house from you, period. FHA makes that promise to you when you sign the documents, that even if the house loses value because they open up a garbage dump or a sewer plant or whatever right next door to you, and property values plummet because of that, FHA doesn't, they're not going to come after you or anything else. They're going to guarantee, that you're not going to go upside down in that. And so it's a very powerful thing to have guarantees in retirement, because a lot of financial planners will even tell you they can't make guarantees for good reason, right? That's why you always see the fine print that, past gains are not, present or future, returns or whatever. But this is one thing that we can guarantee, and it is backed by the federal government, and they do allow us to guarantee several aspects of this, because it just does not add any additional risk to the portfolio. It's the same thing they're doing already in retirement. No changes on that.
Yeah, that's great. Well, thank you so much. I really appreciate you coming. Is there one last thing did we cover everything? Is there anything that I missed, or one thing that you would like people to know about the product?
I mean, I think a conversation's always good to have. I mean, a lot of people think a reverse is that you're doing it because you failed on something. And I can give you countless stories of what I've even closed this year with people that have had 7-figure retirement funds and houses that are worth almost $1 million that we've done this product with. It's not an indication of failure. It's not that you've done something wrong. It adds to. It's a complement to that. And there's plenty of study and research. And if you enjoy reading different research papers about how the reverse mortgage is even used, especially from people in the retirement planning world, it's not from people from my industry, the reverse side. We're not that smart. We allow the financial planners with PhDs that have studied this product and said, this is the best way it can work. But yeah, the biggest thing is it's not a loan of last resort. It is something to be used as complement to a retirement plan, and how it can really be beneficial. And there's no fear. There's never any judgment, because frankly, if I could do a reverse today, I would do one. Like I hopefully will be in that category. I don't quote unquote need one, right? I hear that. I don't need a reverse. Well, I'm going to want one. Like I want to do a reverse when I turn 62, not because it's need based, is because frankly, and I've kind of gotten a little more blunt the more and more I've done this, but the reason I want to reverse is because I can do math.
You'll really be blunt.
I was going to say, I mean, I can do math, and I can look at the math part of it and say, this makes perfect sense. So it's always good to have that conversation. As I tell everyone, even if you decide it's not for you, we'll always be friends. Like I'm 100% Okay, I'm not here to force you to do anything, but I think having the conversation, at least understanding what it is, gives you so much more power in your overall decision-making process than it does if you just never have the conversation at all.
Well, tell us how we can find you, where we find you online, tell us where we can find you.
So, I mean, I think we'll have a slide pop up here in a few minutes here that has all my contact information on it and my email address to reach out and to just ask questions. And, as far as that goes, I mean, I'm licensed in a handful of states. I could be licensed in more states depending on, where the property is. And I can always take a look to see if it's, if it's something I can get licensed in. Some states are different than others, but pretty much our area, Missouri, Kansas, Illinois, Iowa, Arkansas, Oklahoma, Colorado, California, I think are all the ones I'm currently licensed in, if I'm thinking of everything correctly. But we can always, but I'd say, just reach out to me, email me, call me. Let's sit down and talk, or over the phone, we can have a conversation on it and see if this is something that makes sense for you.
Well, thank you so much for being here. I appreciate you taking the time to explain that, because there are so many misconceptions out there. And I think if somebody has any questions, they can give you a call, give you an email, and I think you do an excellent job of explaining it. So thanks so much for being here.
Well, thanks for having me. I appreciate it.